Hey folks, Shawn Plummer over at the Annuity Expert. In today's video, we're going to answer the question, are annuities a good investment or are they a bad investment? And so first off, I want to talk about just annuities in general. If you're thinking annuities are in the same vein as day trading or being in the stock market, you're in the wrong place. Annuities aren't investments. They're really retirement vehicles that allow you to earn interest, kind of like a 401k or a 403b or an I. And there's different risk levels on the types of annuities that you can purchase. Okay, so let's talk about the ways that you can earn interest on your savings in a similar vein as a stock market investment through a financial advisor or day trader. Okay, so there's three different types of annuities that can earn interest. The first one being what's called a MYGA, a multi-year guaranteed annuity. These annuities are CD alternatives. They look, feel, smell, touch. They're almost identical to the way a CD works. The difference is instead of the interest being taxable every year, it's tax deferred. So you want to wait till age 59 and a half or older to withdraw money from it. The interest rates are guaranteed for a fixed term, just like a CD. In almost all scenarios, a MYGA will offer a higher interest rate than any sort of CD out there and for a longer period of time. In most MYGAs, there's liquidity. Most CDs, there's not. There's an option of annuitizing on your MYGA, which I don't typically recommend because it requires you to lose control over your money, and there are better ways of distributing lifetime income on a contractual basis. But yeah, just think of a CD, a beefed up CD. That's what a MYGA is, okay? Right now, you can expect anywhere from 4.5% to 6% in terms of interest up to 20 years, okay? So if you wanted a 2-year MYGA, you can get a 2-year MYGA. If you want to go all the way up to a 20-year MYGA, you can get a 20-year MYGA. If you want a 7-year MYGA, you can get a 7-year MYGA. The rule of thumb is the longer you wait on MYGAs, the higher the interest rate will be for you. So currently we're in a high interest rate environment, starting to decline into a lower interest rate environment. If you're considering getting some sort of guaranteed fixed interest rate, my advice, go as long as you can withstand, because by the time any of these MYGAs, whether it's 2 years or 7 years, when they come up to renew after the guaranteed contract term, they're going to be renewing at a much lower rate because we're highly likely to be in a lower interest rate environment. Right now is a great time to get MYGAs if you're in the market looking for a CD, because this is the highest interest rates that we've seen, and I'm going into my 18th year of this, I think since the 90s. So if you're looking for an interest rate that's guaranteed for a fixed period of time, and then you're able to move it after the term, a MYGA is superior to any sort of CD, okay? Moving on to the fixed index annuity. This is kind of a sweet spot. The analogy that I use is if a MYGA and a variable annuity, which we'll talk about next, had a baby, it would be a fixed index annuity, okay? So fixed index annuity, I want you to focus on two words in that term, fixed and index. And what that means is if you own a fixed index annuity, you have the choice of either earning an interest rate based on a guaranteed declared rate that changes annually, or you can choose to earn interest based on a stock market indexed like the S&P 500, the NASDAQ, the Dow Jones. Sometimes you can do commodities like gold. Bitcoin just got announced in some of these products. But you're not actually in the market. You are basically allowing the insurance company to use the indexes as a measuring stick to determine how much or how little interest that you can earn each and every year based on the performance. And no, you're not in the market. What the insurance company is doing is they're looking at 2 points in time, and they're looking if there's any positive growth from the time that you start the index allocation and the date that the next reset period is. Okay, so I'm recording this video April 7th, 2026. So if you theoretically opened up a fixed index annuity today and you did a S&P 500 annual point-to-point index, they would, at the end of today, they would look at the value of the S&P 500 and they would stamp that into your contract. And then they would look at this on April the 7th, 2027, see what the S&P 500's value is at the end of that day. And if there's some sort of positive gain on that day from today, then there's going to be some sort of lever, like a cap or participation rate, to determine how much of that upside, if any upside, is available to you. Okay. So they use it as a measuring stick to determine how much interest you'll earn each and every year. The cool thing about fixed index annuities, which I think are a good bond alternative, is like when you're in like a down market, because you're not in the market, there's no ups and downs. It's the analogy I use when earning interest in a fixed index annuity is it's kind of like a flight of stairs. If there's a year where you have some sort of gain, you add a step to your flight of stairs. And if the following year there's no gains, or it was a down year, nothing happens to your account. All your gains are locked in, and you just don't earn anything that year. So while everybody else is losing money in the market, you actually stay exactly where you were the year prior. Okay, and because they're using two different dates in a lot of cases to determine how much interest. Well, if you're in a down market, you can earn interest in a down market. So if you take 2008, 2009, when the market, the S&P 500 hit a rock bottom, while everyone's waiting to catch up from their previous high point, the market was doing just fine, you're earning interest while it's going back up. And you are at a place where you didn't lose money prior to it, right? So any interest that you've earned, you've locked in, and it's there, right? Now, with that said, you are capped or you're limited, depending on the annuity, on how much upside potential you can get. So keep that in mind. If you're purely looking at, hey, if I'm looking at a 10+ year time frame and I'm competing against the S&P 500, a fixed index annuity is not it's apples and oranges in terms of growth potential. But it's in volatile markets, it's a good alternative to protect your money, earn an above than average rate of return, and lock in all the gains that you have each and every year and protect your principal. To give you an idea, you should expect anywhere from a 4 to 7% rate of return over the entire contract term. I personally own annuities. My wife owns an annuity, fixed index annuities. And I think our best year, my wife earned like 23% and change. And they locked that in, and there was no fees for that given year. I think it was from 2020 to 2021. So using an annuity broker is really, really important when looking for a fixed index annuity. If you go to a bank, you're highly likely getting a garbage fixed index annuity. If you go to a financial advisor, the same. If you go to a lot of insurance agents or captive agents, the same. The reason being is the financial professional is either limited on what they can provide to you, or you have someone who's uneducated, or you have somebody who's selling a bell and whistle to you, which is distracting, or there's some sort of illustration out there that shows these astronomical returns on your fixed index annuity. In reality, it's not going to return that, right? So if you're going the fixed index annuity route, I think as a bond alternative, it's a good investment. Okay, for the safe part of your retirement portfolio, it's a safe investment. Okay, moving on to the variable annuity. Variable annuities, it's hit or miss. I think when you buy an annuity, the two biggest reasons why people buy annuities is, number one, protecting your principal. Number two, you're looking for lifetime income. Okay, with a variable annuity, you are exposed to the market. You can lose money. It's extremely expensive. It's like 3 to 4% in fees between the bells and whistles of a variable annuity contract. And that might not include any management fees that the financial advisor charges you. And I think after you calculate all the fees and how the market's doing, especially in a volatile market, I think you might as well just be in the market at that point. Because if at the end of the day, 4 to 5% in fees are taken out before you even see a dime, I think there are cheaper ways to get similar results. So not a fan of variable annuities. We can offer them to you, but I think you're better off. If you're looking for principal protection, you're better off with a fixed index annuity. And if you're looking for lifetime income, you're going to do better with a fixed or fixed index annuity with a lifetime income rider, and you're going to pay a fraction of the cost. Okay. Moving on to long-term care annuities. Long-term care annuities, I think, are great. The government is saying if you're over 65, you're going to have a 70% chance of needing a nursing home or assisted living or home health care in your lifetime, whether that's because of dementia or for Parkinson's or any sort of, old people problems. And not a fan of how our country is running the long-term care. It should not cost a 80-year-old or 85 or 90-year-old $100,000 plus a year to stay in a nursing home. And you shouldn't have to go completely broke to get into the state's Medicaid program. So we always recommend at least taking a look at a long-term care annuity. The way it typically works is you do some slight medical underwriting, which typically entails a phone interview. You got to answer some medical questions. They check your medical history and your prescription drug history. Based on that information, they'll either take whatever money you're willing to invest into a long-term care annuity and either double it or triple it to pay for a nursing home or assisted living or home health care. So for example, if you invested $50,000 into a long-term care annuity and you came out with flying colors in terms of health, that $50,000 could day one equal $150,000 worth of long-term care benefit. And then typically you get to go pick out your service or your facility, as long as it's state acknowledged and licensed. And then you can use that $150,000 to pay for those expenses. So if you've got Parkinson's, dementia, or Alzheimer's, or any sort of medical condition in your family, I think a long-term care annuity is a great investment, and it's not use it or lose it. So if you don't use it, it'll pass down to your beneficiaries. And so the insurance company doesn't keep that. And from the types of long-term care annuities that we recommend, once it's paid for, it's a one and done. So there's no horrific nightmare story like most traditional long-term care insurance companies offer, which are, hey, it's semi-affordable, expensive, but still doable, buying long-term care insurance at age 60, 65. But when you turn 75, 80, 85, it doubles or triples in price, and then you can't afford the premiums for the long-term care insurance, and then you have to cancel it, and then all those premiums went to the insurance company, and then now you got to pay out of pocket and go into the Medicaid route and go broke before you can actually have someone help you pay for the service or facility. So in that scenario, long-term care insurance, traditional long-term care insurance is not a good investment. Asset-based long-term care insurance, like a long-term care annuity or a long-term care life insurance policy, is a good investment because it's not use it or lose it. And unless you're a multimillionaire, anyone telling you that you can self-fund a nursing home, you should pack your bags and run as quickly as possible. Because at the end of the day, if it's not use it or lose it, there's zero reason for you to pay $100,000 a year for a private room in a nursing home. Zero. Not when you have the opportunity to cut it down to a third of the cost. So my opinion on that. SPIAs, don't really think SPIAs are good investments. You're not earning interest. And if any sort of interest is baked into the payment. Right now, currently, SPIA payments pay less than lifetime withdrawals on a lifetime income rider. Same thing with DIA. It's just, they're so rigid. why would anyone want to give up control over their money to an insurance company in exchange for irrevocable stream of payments that are lower than purchasing a lifetime income rider on a fixed index or variable annuity? Okay. Same thing with DIAs, waste of money. It's just, it's too rigid. There's little to no flexibility. The payouts are lower than most lifetime income riders, and we're in a high interest rate environment. And if you don't structure it correctly, you could lose all that money and there could be no death benefit. So I think SPIAs and DIAs are long gone. And in 18 years, I've never seen them be a solid investment. QLACs are good if you're wealthy and you want to try to defer some of your RMDs up to age 85. I think fine, you can do that. I think there are better ways to take out your RMD, and you're limited on how much you can defer. I think last time I checked, it's up to $210,000, $211,000. So if you're wealthy, that's not even scratching the surface in terms of RMDs, but it's there if you want it. I think annuities with enhanced death benefits are a great investment. Look, if going back to long-term care, if you're not in good health, you're not going to be able to get life insurance, right? Because you're in bad health. Insurance companies don't allow you to get insurance if you have cancer, right? You have to wait and survive it before you can try to get any sort of life insurance. So if you come into a situation where, you're terminally ill or you're really sick, you can move some of your retirement accounts. I think your retirement accounts are the best route to go because there's no step up in basis at death, where you can move it over to some annuities that'll give you up to a 50% bump in the death benefit day one. So if you had $1 million and you were terminally ill, you can move it into a certain fixed index annuity with an enhanced death benefit. And day one, your $1 million equals $1.5 million. And then you earn interest on that, right? And then when you die, your beneficiaries get to collect on that. I think that's a good investment. I don't think there's any, even if you're comparing that to being in the market, it's going to take you years to get up to a 50% increase and then start earning interest on top of that, right? So you can do that day one. I think in terms of annuities and keeping up with inflation in retirement, I think it's one of the best investments out there. I think it's really hard to keep up with inflation, especially in volatile markets. The way that works is you get a lifetime withdrawal for the rest of your life. And then every time either the CPI goes up or you earn interest on your account or even a fixed interest rate, like you can apply that to your payment. And every time that you get some sort of return or there's an increase, that increase is applied to your payment. Okay. So your payment can increase throughout the years, and you're maintaining keeping up with inflation and maintaining your lifestyle for 20 plus 30 years, and you're going to need that because as you get older, it's going to cost you more in terms of medical expenses. So I think that's awesome. There's Medicaid Compliant Annuities that if you're that I think are great. It's very niche, but if you're a couple, my grandparents, my grandfather is still alive. He's 95 years old and he's in good health. And my grandmother died of Parkinson's disease. And if he would have had a Medicaid Compliant annuity, instead of sending all of your money to a nursing home, he's able to take some of those savings and put it into an annuity to pay him an income stream and allow my grandmother to qualify for Medicaid. So they don't have to go completely broke. But that wasn't the case for him. He didn't know about it. He didn't get it. And, my grandmother who had Parkinson's for a long period of time, he had to get her in and out of a chair. He had to clean up after her. And all he could really afford was to have a person come in once a week to give her a bath. And, being in your 80s and 90s, you're not very strong. So, when we went down to visit with him once, a couple months before she passed away, he wouldn't even go to the local grocery store, even knowing that we were there to take care of my grandmother. So it's tough. So a Medicaid Compliant Annuity could have really helped him out. It probably could have paid some money to get that home health care worker come in maybe 2 or 3 times. So she got a bath 2 or 3 times a week versus once a week. So I think the point I'm making is annuities aren't investments in the sense of you're in the stock market. But anyone that tells you that annuities aren't good investments are full of shit. And you should really, if you can't talk good about something, that person is usually full of shit. And you should think about the decisions they're making on your behalf. It's just a real sticking point. When I hear people, especially popular YouTuber, and you know who I'm talking about, you see them on YouTube giving you financial advice, a lot of times those guys are full of shit when it comes to annuities. And I could go on a one-to-one debate with them and prove them wrong and make them look like a fool. So annuities are a good investment for most retirees. I think it solves a lot of problems that money managers can't solve by putting your money in the market. Okay. I think from a lifetime withdrawal standpoint, if you're looking for your retirement income foundation, I think an annuity with a lifetime income rider is far superior than having a financial advisor manage your money in the market and use their 4% rule and adjusting for inflation. I think a lot of people are going to be in a lot of hurt over the next couple of years if the market continues the way it's going and being extremely volatile. 2008, it happened. A lot of folks who were about to retire had to continue to work until the market got caught up because they just didn't see it coming. Okay, so now, with that said, where annuities are garbage investments. If you're looking for all the upside in the world, I don't think there's any in the market. I don't think there's any annuity out there that will compete with it. You are better off being with a financial advisor, managing your money, or being a day trader. If you're looking for, the flexibility of taking money out or cashing in on a daily basis, run away from an annuity. If you're not into paying hefty fees, run away from a variable annuity. If you're if you're a control freak, and I'm talking to you control freaks, if you're a control freak, don't buy an annuity. Don't be stupid. Go find somebody that you can go manage your money and you can call and pester every single day that you're having them manage your money and talk to them. Don't buy an annuity, because for the most part, annuities in terms of growth, it's kind of a set it and forget it type of deal. Every year every anniversary date, you're going to get a notice to reallocate how you want to earn your interest. And then once you fill out that form, it's set it and forget it. You don't see it until the next year, because you're not actually in the market, unless you have a variable annuity, of course. What other arguments? There's an argument that there's no basis at the time of death with annuities. Okay, that's fair, but most annuities are funded with qualified retirement accounts, and most qualified retirement accounts don't have basis step up at death. Annuities avoid probate in most states. So, in terms of estate planning, I mean, you name the designated beneficiary, go straight to them. You're going to save money, I think, in a lot of areas with annuities. If you buy the right annuity, the annuities that I own, I pay no fees on. And I've averaged about 6.5% to 7%. I think with annuities, I just, in terms of a multi-feature tool, like a certain knife that I won't name for copyright reasons, I think it's the financial tool for retirement. Okay. Oh, you know what else is cool for an annuity? If you're in your, let's say your 40s, man, you are. I've seen a 42-year-old invest into an annuity with a lifetime income rider with like 400,000 and change. Okay, from like a 401k. And they were contractually guaranteed $100,000 a year for the rest of their life, starting at age 62, 63, right? You're going to need, if you did that same scenario with a money manager, you're going to need about $2.5 million to get $100,000 a year. And that's not contractually guaranteed. And you're paying a third of the price in terms of fees to get that same result. So if you want to like have a personal pension plan and know 20, 30 years in the future what your income outlook is for peace of mind, dude, annuities are awesome. Okay, you can't do that with a money manager. Going into last thing I'll talk about, in my opinion, whether it's a good investment or not, commissions. Man, I hear these money managers, I see them on TV, you know, the commercials around 60 Minutes. They talk about hefty fees and commissions. Look, I'll stack up a financial advisor managing money for 10 years and charging a 1+% fee plus fees that they pay in bells and whistles up into a 3, 4, 5, 6, 7% commission, one-time commission that a salesperson earns on an annuity. And the money manager will lose almost 10 times. I don't want to say 100% of the time, but I'm going to say 98% of the time. Because it's simple math. You earn a 7% commission on, let's say, $100,000. That's a $7,000 commission one time for whoever sold the annuity to you. Okay, you charge a 1% fee, which is like the conservative management fee. You're getting you're paying 10%. Difference between the two: the insurance company pays the commission to whoever sells you the annuity. So it doesn't affect your annuity positively or negatively. It's the actuaries already price in the commission. But you work with a money manager, good or bad market environments, they're charging that 1% fee. That's 10% at a minimum over a 10-year period. So think about that. We go into a bear market, and we're not doing so hot like 2009. They're still charging you that fee. Still expensive. So the point I'm trying to make is, like anything, annuities aren't for everybody, but they solve a lot of problems, and they do I would go as far as say they solve a lot of a financial advisor's problems in retirement, and they do a better job at it, whether that's automating retirement income, having a safe growth investment, having principal protection, long-term care, inflation protection, enhanced death benefit for a life insurance alternative, helping a couple deal with Medicaid without going broke. I don't think managing money in the market competes with that. But if you're looking for the most upside potential, and you're a control freak and you want to move things around on a daily basis, stay away from annuities. Hope this video educated you a little bit, give you a different perspective. If you have any questions, or want to have a free consultation, or want to see a quote or an illustration, go to your favorite search engine, Google, Bing, Yahoo, type in the Annuity Expert, and we'll offer free calculators to you, free quotes, free advice, no obligation, let you compare apples to apples, and we'll help you out. Our phone number is 770-755-1565. And once again, type in the Annuity Expert, we'll show up and we'll be able to help you out. Catch you on the next video. Like, subscribe, and leave comments. If you got a comment, leave it. I'll answer it. I'll even answer your question right there in the comments. So please engage with the video, good or bad. At least let me give you some accurate advice about what your opinions or feelings are. Okay? Thank you. Have a great day. We'll see you on the next one.